Hey guys, it's Stan here. Today we're gonna talk about the cash conversion cycle. So last week in my video I was talking about the working capital and I was telling you how important and how absolutely essential working capital is to make your company a better place. So in this case here, the cash conversion cycle is absolutely fundamental for your company because it can make or break it. So in today's video we will learn what the cash conversion cycle is, how to calculate it, and how to improve it over time. So let's jump into the topic and define what the cash conversion cycle is. So to understand the cash conversion cycle, you have to look at, it doesn't matter which company, and you will see that two very important processes stand out when it comes to cash. The first one is the purchase to pay process, and the second one is the order to cash process. Now, if I was a fancy consultant that paid $10,000 a day, I would just tell you, yeah, you have to improve both of your processes and that's it. Thanks for the $10,000, you know. Since I give you free advice here, I will explain both of it in a very detailed manner so you can easily understand it and improve it in the future. So let's start with the first process on the left here, purchase to pay. So I have listed the different steps that usually a company goes through. Usually when you produce something, let's imagine I produce this great glass bottle here. I'm gonna buy materials from my suppliers, I'm gonna produce goods, I'm gonna build inventory, and at some point I'm gonna pay my supplier. Now obviously this is a physical goods company, but even if it's intangible assets where royalties and this kind of stuff is involved, you will maybe not have physical goods and you will probably not build physical inventory, but you will definitely buy something and pay someone at some point. So let's say, let's start with a physical goods company because it makes it much easier to understand and to explain and to improve. So this is the first step. When you look at the purchase to pay, you have these four elements inside. Now let's look at the second one, which is the order to cash. So this one only has two steps, which is make a sale and collect cash. To make a sale, obviously someone ordered, it doesn't matter if it's online or at your online shop or at your warehouse or in your store maybe, but someone, you made a sale to someone, and this person at some point paid you, which means you collected the cash. That's why you only have two items here in this process. So now I have a question for you. Where in these four and where in these 2 points is cash involved? Where do you see cash going in or going out? Well, let's go through it together. Buy materials, so purchasing material. If you purchase materials and at a supplier that you already know and you have payment terms and stuff like that, so if you're not a private person, but if you are a company, usually you have an agreement with him or with her, telling him that you are gonna pay him at some point, but not at the moment where you purchase the material. So when you buy the material, there is no cash involved here. It's just a purchase. It's a cost right now. It goes into your P&L, but not in your cash flow. I will talk about that in a minute. Producing goods. Let's imagine you already have the factory and all that stuff, and we're only talking about the production costs. That means that here your maybe costs are involved, but you are still not paying. So this again is not going into your cash conversion because there is still no cash involved here. You're building your inventory, and again here, if you already have your factory, you're not gonna pay for anything. You're building your inventory with the goods and the machines you already have. So again, no cash involved. But look at the last point, pay supplier. That's where the cash comes into play here, okay? So this point here is relevant in the purchase to pay. Now, when it comes to the order to cash, same question, where is cash involved? Let's imagine someone purchases something at your store, and imagine you are selling 1,000 of these bottles because you're a wholesaler. You're not gonna get the cash directly, right? Because that's how it works usually with big companies. So When you're making a sale, you are not getting the money right now because you're not a private person. You're not going to Apple and you're paying for your iPhone right now. Okay, so it's when you're making a sale, you're not getting the cash instantly, which means that only the second point here has cash involved. Okay, so you see that a lot of stuff on both processes are happening before cash is involved. And that's gonna play a major part in the cash conversion cycle that we're gonna discuss right now. Okay, now maybe to make it simpler, let's look at chronologically on it, okay? So when we look at the cash conversion cycle, and you will directly understand why it can make or break a company, the cash conversion cycle, and why it's so fundamental, look at the chronology here. We are purchasing our material, we are producing the good, we are building the inventory, we are paying our supplier, that's negative for our cash, we are making a sale, and only at the end of the chronology we are cashing in because we get the money from our first sale. So you can see that there is a pretty big gap here between paying your supplier, cash out, and collecting cash for your sale, cash in. As you can see, that's a part of the conversion cycle, and you can see that from the first time you have costs involved and cash out going out, it's a long way till the first time you cash in and you make a sale here. Okay, now we're gonna need a little bit of accounting. So what's the difference between when you purchase something and when you pay a supplier? Well, in accounting, the point between here and here is called an account payable, AP. Account payable, that's the difference between your cost and the payment at the end. Same on the other side, when you make a sale, you still have not the cash because you are collecting later. So the difference between your revenue here and the collection of cash, at that time you have what is called an account receivable, right? So in this case here, you have a supplier debt because you owe the costs, you owe the cash to your suppliers. And in this case here, you made a sale, so you made revenue, but your client is still owing you money. That's why you have an account receivable. Okay, so now we have all the ingredients to calculate our cash conversion cycle. So for our example, we need the formula of the cash conversion cycle, and for that I would like to introduce you to a few new items here. So the cash conversion cycle formula is days of inventory outstanding plus days of sales outstanding minus days of payables outstanding. That sounds super complicated, but if you have understood the chronology here, it's going to be pretty simple, and we're going to add some numbers. It's going to be super easy. So first of all, what does it mean? Days of inventory outstanding, I put it here on our chart. Days of inventory outstanding is the difference between the time you have built your inventory and your first sale. As we said before, obviously it's cost you money to build inventory without selling it, because you're just, imagine your warehouse where you have produced all these bottles without selling them, okay? So obviously that's gonna have a negative impact, you know, on your cash conversion cycle the longer it gets. So if you build inventory and you make a sale, you should make it shorter, but I will give you advice at the end of the video. Just right now we are just in the formula. So days of inventory outstanding, difference between build inventory and make a sale. Then days of payables outstanding, that's the days happened between your purchase of the material and when you pay your supplier. Because obviously you see here it's only a cost, but here it becomes a cash out. So actually here you have no cash out and you can already start producing and stuff like that. And at some point you have to pay your supplier, okay? So for your cash conversion, it plays a role. I will tell you exactly which role. And the last one, days of sales outstanding. That's the difference between when you make a sale and when you collect the cash, there are a certain number of days, and that's going to be very important as well for the cash conversion cycle and for the formula. So now you know all these three things, and try to understand them properly on the graph. Please comment if it's not clear, and I will help you again. So now we have the basic tool to understand the formula and to add some numbers. To calculate the cash conversion cycle, you just need 1, 2, 3, 4, 5, 6 numbers. Very simple. So let's jump into it. I purchased materials for $10,000. My accounts payables means the debt I already had to my suppliers was $1,500. The inventory at the beginning of the period, let's say at the beginning of the year, was 500, and right now it is 1,000. So there is a variation of my inventory, obviously, between the beginning of the period and right now. I made a sale of $20,000, and my clients still owe me $2,500, which are my accounts receivables. So now let's look at the formulas and how we're gonna get to this one, which is the cash conversion cycle formula. So first of all, my days of inventory outstanding, that's average inventory. So we're gonna calculate the average inventory here. That's gonna be 750. So divided by the cost of goods sold times 365 days, which are the number of days in 1 year. But what is this COGS? What is the cost of goods sold? Well, it's very simple. It's what you have to spend to sell your product without the labor. So as you can see, the cost of goods sold here, that's the starting inventory, 500, plus all my purchases, 10,000, minus my end inventory. So as you can see here, you look at how much did I spend on my purchases and how did my inventory evolve, because obviously the evolution of your inventory tells you if you have sold or not any products. So let's start calculating our costs of goods sold, because we're gonna need them here and here. So cost of goods sold, starting inventory, 500, plus my purchases, here, 10,000, minus my end inventory, which was 1,500 in total. Okay, so that's my cost of goods sold. Now let's move on to the DIO, days of inventory outstanding. So my average inventory, when I go from 500 to 1,000, it's gonna be right in the middle, so it's 750, my average of inventory, divided by the cost of goods sold I just calculated, 9,500, times 365, which are the numbers of days during the year, 9. One little tip, when you calculate days of inventory, days of payables, days of sales outstanding, please round the numbers, because we're talking about days. So here it's going to be 29 days. It doesn't make sense to put 28.7 days, right? That's useless. Now let's move on to the second one, days of payables outstanding. So my accounts payables, as you can see, were 1,500. 365 divided by my costs of goods sold, which were 9,500, which leads to 58. Moving on to the next one, days of sales outstanding, 2,500 divided by my sales. My sales were 20,000 times the number of days in a year, 365, leading to 46. So now let's look at the formula here. It's days of inventory outstanding plus days of sales outstanding minus days of payables outstanding. So let's start. DIO 29 plus DSO 46 minus DPO of 58, 17. So now what does it mean here? Well, let's start with the top. First of all, DIO, days of inventory outstanding of 29. Let's look back at the definition. It means that between I've built my inventory and I made my sale, 29 days happened. This is the interpretation of 29. Second one, days of payables outstanding, 58. What does it mean? Well, it means between my purchase of the material and my supplier payment, 58 days took place. Okay? DSO, days of sales outstanding, the difference between when you make a sale and when you collect the cash. So here it took us 46 days to collect the cash of my sale. So what does it mean when we look at the cash conversion cycle of 17? First of all, it means the 17 means it took me it takes me full 17 days to get my cash converted, which means basically I need to fund 17 days of my business activity to get my company rolling. Okay, so if I do not have 17 days of cash, if you want, you're not gonna be able to go through all the cycle. This is what it means. So if we go into the details, look at the three numbers. First of all, you have two numbers playing against you and one playing for you, if you want. So first of all, days of inventory outstanding. Inventory is kind of a good thing and a bad thing. First of all, inventory, obviously, you need some inventory to make a sale, that's for sure. But on the other side, if inventory costs you, first of all, you have to purchase the material, put it somewhere, and as long as it's kind of sleeping money, okay? So don't forget that inventory can play against you if it's stuck somewhere, okay? The second number, DSO, of 46, also plays against you if you want, because now you were able to make your sale, but you were not able to collect the cash. So the faster you collect the cash, the better it is. And the last number, DPO, outstanding, kind of plays into your game if you want, because the later you play your supplier after the purchase you've made, the better it is for your cash conversion cycle and your working capital. I did not mention the working capital on purpose because I made an entire video that I'm gonna link over there. So if you're interested in working capital, which is kind of the broader topic of the cash conversion cycle, it goes hand in hand. You should definitely watch this. It's about 20 minutes long and it's gonna open your eyes on working capital, which I mentioned at the beginning, same as the cash conversion cycle, can make or break your company. Okay, now that we know what the cash conversion cycle is and how to calculate it, we're gonna think about how to improve it. Let's go back to the formula here, first of all, okay? Let's do a little bit of math. The goal here, obviously, you wanna have a low cash conversion cycle, because obviously the bigger the number here is, the more days you have to fund to be able to realize all that. So don't forget that. So what do I have to do to minimize this number? Well, first of all, your days of inventory outstanding should be the lowest possible. Your days of sales outstanding should also be the lowest possible. And your days of payables outstanding, in the formula you are withdrawing them. So you want this number to be as big as possible to minimize the end result. So okay, that was the mathematical part. Now let's talk practice and how you can easily do it. First of all, as I just mentioned, look at the days of inventory outstanding. So that's the gap between building inventory and making a sale. Obviously, you want to keep this gap small, which means you don't want to overstock, even especially if you are a startup. Do not overstock, do not try to get crazy bulk prices because you buy a lot, especially if you don't know the demand. Think about Tesla. You can think, oh, Tesla is good or not. You can be a fanboy or a Tesla hater. But there is something which is phenomenal with Tesla. Actually, they are teasing a new vehicle, a new car that they just produced, maybe one item, just a prototype. And then the demands are going up. And then they know, okay, right now we have 500,000 demands, so we know how much to produce up front. So they never have inventory because the cars they even have not yet produced are already sold. So this one is definitely key. Make sure your inventory is the lowest possible. Let's put it like this. And try to check your demand and see if you can sell quickly or if there is absolutely no demand for your product. Okay. Second point, days of sales outstanding. So that's the part here. Obviously, you want to be very mindful here because it's not because you just made a sale that you already got the cash. So this should also be reduced, obviously, because you don't want to wait forever for your cash, because it's gonna make your cash conversion cycle longer, which is very bad for your activity. So in this case, be very mindful when it comes to collections, and also do not. Obviously, you want to sell to anybody, but maybe that's a mistake. Don't try to sell to anybody. Check the credit ratings as well. The company has a very bad credit rating. Maybe do not sell them because you're gonna get your sell here, but they're never gonna pay you or very late. So that's very bad here for you as well. So DSO should be lowered. Mindful of collection, but also payment terms, because let's say I'm selling a ton of these my fancy glass bottles here, and my client tells me I'm gonna pay you in 60 days when the industry standard is 30 days. So be mindful and set the payment terms the right way at the beginning. Obviously, it's gonna be easier if your client is smaller than you. If you're dealing with Apple as your client, it's gonna be a different story. Last point here, DPO, days of payables outstanding. We are talking about this section here. So obviously you want to increase the number here, because the day you purchase your material and at some point when you pay your material, you want that to be the maximum in the future possible. So here again, we're going to talk payment terms with your supplier, and it's going to be very, very important. So here I understand that some of the metrics like accounts receivables, like accounts payables, cost of goods sold, and all these things are very much related to the financial statements. So if you're struggling with the financial statements, I also made a video that I'm going to link here and the description below. It's roughly half an hour long, and it's going to really help you to distinguish between the financial statement and to fully understand the links, which going to make all this much easier. Little teaser for next week's video. I'm going to talk about the most important metrics you have to look at when you try to analyze a company. It doesn't matter if it's in cash flow, balance sheet, P&L, and all that stuff. And a little hint, it really depends on the stage of the company. So if it's a startup or if it's a grown-up business, and obviously at the year and at the size of the company. So it's not like you're just looking at the free cash flow and say, oh, they're generating so much, and that's the end of the story. It's gonna be much more elaborated, and it's gonna be a bit theory and a bit of practice. So make sure to stay tuned, subscribe and like. See you soon, guys. Bye bye.